All right, so Matthew, take us back before real estate, before finance. Bring us just back to the beginning. How did you get started and how did you get into this industry?
Well, first and foremost, David, thank you very much indeed for having me on your show. So let's just make that clear that it's an honor and a privilege to be on. So going back before I came to the US, which was about 9 years ago, my career started out as a stockbroker, and I then moved into corporate finance. But for the last 25 years or so, I've been an entrepreneur. So I run my own businesses, pretty much in technology and finance. And real estate was one of those things that I'd always been really interested in, but it seemed quite slow moving, and I never really got involved to any great extent. But when I moved over here, one of the things that I really wanted to do was immerse myself in real estate, because over here, real estate is a very different animal to what it is in the UK. It's far more interesting in the sense that there are far more parts to it. It's a much larger industry. And there are far more things that you can do in terms of the different layers of financing, from private finance and bank finance and hard money and all this. There are wheels within wheels, as it were. And fun enough, when I came over here, it was hot on the heels of the Jobs Act, which was the Jumpstart Our Business Startups Act, which was passed into law by Barack Obama. And what that did was that really paved the way for online investment platforms and gave birth to pretty much all of the real estate crowdfunding companies and all of those other online investment companies that we see today, which is now a multi-billion-dollar business. And so I started off by launching a crowdfunding company for real estate. And what that did is that combined all my previous sort of knowledge and experience in finance and technology, but within a real estate environment. So it's actually quite exciting because we were raising money for projects from investors online. So it was very much in the early days. It's amazing how that industry as a whole has grown incredibly over the last 8 or 9 years, and continues to grow phenomenally as well.
Yeah, fantastic. So you came over from the UK, and the real estate industry is just much bigger of an animal. You find out, and so as you know, as our listeners know, I mean, when we talk about this business and that big animal, I mean, there's so many different facets that you could focus on. So you went into the crowdfunding aspect, and so it sounds like you went right into the financial aspect of the business very quickly, the raising capital. The financing of specific projects. Did you just were you focusing all your time and energy on this platform development, or were you kind of dispersed? What did that look like, and what did you learn in those early years?
Well, it was 100% focus, really, because the platform itself has a number of different pillars, as it were. So you have the technology side of the platform. In other words, how do you actually make something that delivers things from a technology perspective? Then you have the legal aspects. In other words, you're dealing in securities, you're dealing in finance. So how do you navigate US securities laws? Now, coming from a UK environment where I was, pretty immersed in UK regulations, there were some similarities, but not that many. So it was a really sort of good learning experience to get knee deep, as it were, in understanding the legal aspects.
Can I pause you there for a second? Would you say, I'm just curious, is the United States more regulated or less regulated, or is it about the same with just different nuances?
I think it's about the same as the UK, but with different nuances. In other words, there are some areas that are very clearly defined, and there are some areas that are open to interpretation. And I think compared to UK and at that stage European law, there tends to be more clarity within European regulations, or UK or European regulations, and that's not a good thing or a bad thing. I think it's just my interpretation. So I just I noticed that with some of the interpretation of US securities regulations, particularly in the environment of a changing regulatory environment, because with the impact of the Jobs Act, that changed the way that investors could be solicited or could be approached online. So I think there was still a fair amount of gray area around the edges, which, and again, if you think about the impact of blockchain and cryptocurrencies and those types of structures and investment vehicles, the interpretation of, and I think that's the same, across the world. Really, I think most regulators are sort of scratching their heads, thinking, "How are we going to deal with this?" So that's
what is this? What does it mean?
Yes, yes. But it's really interesting to see this sort of the fact that some of the answers that I was getting was, well, we don't really know. In other words, you can try it here are the guidelines, but I think a lot of the things that we and many other people were doing at that stage really was, trying to be as compliant as possible, but not fully understanding. I don't think anyone really knew what the real the guidelines were, but that's become a lot clearer now.
Yeah, definitely. So, I mean, I definitely think that we are in the real estate industry, a technological revolution. I mean, it seems like I'm in a hotbed of tech activity here in the Phoenix market. It seems like every technology-based real estate company comes here first to test out their products. We are a guinea pig, and many of them, they come and go, off the scene very quickly. And that's just innovation in general, right? You may have 100 companies and one or two survive and emerge victorious. I mean, being that you were part of the early days of kind of this platform investment vehicle, I mean, you've seen a lot of competitors come and go. What do you think has set you apart and what you're doing so that you can have been able to succeed in this business?
Well, I think really we've seen far more companies stay than typically would go. So I think generally what you're saying is has a good deal of truth, in the sense that if you look at startups generally, particularly sort of technology startups, there is a large attrition rate. And that's for a number of different reasons. It's not just because they're technology companies, because it could be for any number of reasons to do with businesses generally. But what we have seen, though, is some huge successes with the early crowdfunding companies, and there are dozens of companies. And if you look at the amount of capital that is invested in real estate through these platforms, it is measured in billions of dollars. And I think real estate is one of those areas where it is difficult to innovate, because there are so many legacy systems and so much legacy infrastructure in place. But ultimately, it is moving, and there are so many different areas of real estate that are ideally suited to innovation and to technology. And some things will take a long time to move. But if you look at the intersection of fintech and prop tech and real estate, now, in other words, fintech is how you is the innovation of technology to do with money and finance. In other words, raising capital in innovative ways. Prop tech is really where you're looking at real estate and applying a technology layer so that you can do things with it in a way that's different to what it was before. And then you have real estate itself, which is the underlying asset, the house. And I think really what we're seeing is just a movement that allows the asset itself to become freer, and that's what we do. So with real estate, with residential real estate in particular, it's somebody's home, but it's also an asset. And for most Americans, in fact, most people around the world, their home is their largest asset. What we do is we have a structure, a financial structure, and we have technology that enables that asset to become more freely tradable, to become more accessible. And we can talk about it in a moment, but what the effect of that really is that by applying technology, you're not seismically changing anything for the homeowner, other than the fact that you're bringing in, through this more efficient mechanism, different ways and different funding structures and different ways of dealing what is essentially a very valuable asset. And what these technologies do is really just allow a wider audience to have access to those assets. And I think that really, if I was to sort of put it in a nutshell, I think what technology does is it makes it easier for more people to get involved in things that previously they would not have had access to.
I really love how you put that, because I think, whether we're talking, like you said, fintech, prop tech, whatever, probably one of the most widely recognizable examples of what you just brought up is, the Robinhood example of, something that stock trading, became much more accessible through having it available on a consumer's phone. And we saw there's a lot of positives to that. There's some negatives to that, to, the untrained investor. But the accessibility as a whole is something that I think is probably a great advantage. So Matt, I'm curious, like take us into what you do specifically then in this world. I mean, you mentioned this crowdfund was where you started, but where are you at today? Like what specific problem are you helping to solve today?
Well, we started QuantmRE 4.5 years ago to solve a specific problem, and that is, if you are a homeowner and you have significant equity in your home, the only way that you can access that equity is to go deeper into debt. And we found a structure which is a non-debt-based structure, an equity-based structure, in other words, that is used every day in commercial real estate transactions, that enables a homeowner to unlock potentially life-changing amounts of equity from their home without the need to go deeper into debt. In other words, without using loans or mortgages or reverse mortgages or HELOCs. And so we are investors. And what we say to the homeowner is, we will invest with you as partners. We don't go on title, so don't worry, we're not going to come and knock on your door and camp out in your spare bedroom. But in exchange for a capital investment from us, you agree that when you sell your property, or if you decide to buy us back, which you can do at any time without penalty, you will give us a pre-agreed percentage of the value of your home. So effectively, what we're doing is we are buying a share of the future value of your home in exchange for cash today. And that's a great advantage for homeowners who are unable to borrow money. So particularly over the last couple of years, we've seen some tremendous house price appreciation. I don't think anyone really forecast the increase in value of homes across the US. But that's left many homeowners in a position where they are, as you could describe it, as being house rich but cash poor. Their economic situation hasn't changed, even though they're now worth hundreds of thousands of dollars. On paper,
on
paper, they can't get hold of it because maybe their credit score is too low, or their debt to income ratio is too high, or maybe any number of other factors, or maybe they simply have locked in at a 2% rate or a 3% rate and don't like the idea of letting go of that. So in other words, they can't refinance. So what our programs do, and we're not the only company doing this, this is a movement. In other words, we're seeing billions of dollars of investment going into homeowners to participate in the equity upside of their homes in exchange for cash to the homeowner. So we saw this begin about 4 to 5 years ago, which is when we started Quant. And we do something very different to all the other companies. And there are about 5 other companies in this space. And what we do is we take that home equity agreement and we use blockchain technologies to offer that out in fractions to investors who want to get involved in this type of asset class that actually is only available to institutions and large multifamily offices. So it's the pension funds, it's the large endowment funds those are the guys that are currently funding these home equity agreements. So we saw that was happening, and using everything that we learned within the crowdfunding space, and thinking that this is probably going to be the next major real estate asset class. We built a platform that enables us to originate those agreements with homeowners, and at the same time, we enable investors to buy fractions of those. And we made an announcement last week that we've solved the final piece of the problem, which is the regulatory approval to enable those fractions to be able to trade.
Oh, wow.
So what our platform does is it enables a homeowner to unlock or access the equity in their home, and our platform makes it accessible, investable, and tradable. So we're using technology, we're using blockchain as a very effective way of controlling how the ownership is recorded. But what we're doing is we're making the equity in your home tradable, and you don't have to move. You don't have to make any monthly payments. The money that you get is tax deferred, so you don't have to pay any income tax or capital gains tax on it. And it's a very, very useful tool. And again, your question was, what problem does this solve? So it solves a problem for homeowners who want to be able to access their home equity without taking on more debt. And it also opens up I think the size of it is like $23 trillion. There's over $23 trillion of equity in single family homes in the US. So it makes that equity, and the most important piece is, it's the equity in owner-occupied homes. So if you think about your neighbor, potentially you could invest in the equity upside potential of his house without him having to move out. You don't have to rent homes. So it's a much better model than having to buy a house, get a tenant, fix the roof, take the trash out, unclog the toilets, all those sorts of things. So you can benefit from the equity appreciation in a way that you can also trade that paper, and you don't have to be a landlord. You don't have any of the frictional costs associated. And at the same time, we're helping potentially millions of Americans unlock their equity without having to borrow more money.
It's so many different directions I want to go.
Yes. I want it's live. The great thing is it's actually live.
So you can do this. You can do it right now. And it gets me so excited because really there is a democratization and accessibility that you are providing to those who may not be able to invest at this level. Like you said, a lot of it is, your endowments, your these other big, investors coming in. You are making this more of a commonplace thing. And what I want to ask, you mentioned really early on in that, Matthew, that, it's similar to something that maybe has existed in the commercial space, but has not been brought into the residential space. Was that the genesis of this idea, or how did you originally come up with this? Were you first to market, or was it another competitor?
No, it's been around. So home equity agreements have been around for over 10 years, 12 years. In fact, they were really created by a company called Equity Key, who were based in San Diego. In fact, one of the original founders of Equity Key is one of our shareholders and advisors. So we stumbled across it really, I think it was at a conference somewhere where someone was talking about this type of structure. And immediately it resonated, because when you're trying to do multiple deals, and I think most people that have invested in deals realize that each deal tends to have its own characteristics. So you have to manage each deal. If you're a property owner, each property is different. If you're an investor in a loan, each loan has its own characteristics. You have to manage each loan. So to build an online investment platform and scale it is actually very challenging, because the more deals you bring on, the more moving parts you bring into your business, because each one of those deals has to have its own sort of loan officer or its own manager. But this asset class is really interesting because it's very passive from an investment perspective. I don't look after the property because I don't own it. I'm not responsible for paying the mortgage. The owner is. I'm not responsible for paying the taxes. I don't cut the grass because that's the owner's job. And the owner takes pride in their home because they have, even after our investment, a large amount of equity left in the property. We make sure of that. So what we're doing is truly leveraging that homeowner's position as an owner of a property to be able to benefit from the equity upside there. And the owner, they get the benefit too. So it's a two-way benefit. It's this sort of fabled win-win situation. But it's a great asset. And what was really interesting was this scalability, the concept of this could be incredibly scalable because it's just a contract. You don't need to own the property. You don't need to do all those things I just spoke about. And what we've seen is as property prices increase, there is more and more demand now for homeowners who are very motivated to access some of the equity that is in those properties. And at the same time, we're seeing investors finally understand what a great investment this is because it gives them exposure to that equity. And the way the agreement is structured, and this is really interesting and very important, is even if the property goes down in value, the investor can still make a return because it's an option agreement and there's a bit of a cushion built into it. So even if the property value goes down, then the investor can still make a positive return. And I think everyone's getting slightly nervous about where property is going. So to have an investment structure that is backed up by a lien on real estate that even pays a positive return if the property goes down in value, that's all of these things are coming together. So, we are excited, very, very excited about what this, where this is going to take us.
I love it. And so you said one of the differentiating factors between you and, the four or five other competitors that are in this space right now that are really players, is your application, involving the blockchain. And I'm curious, when we talk about the blockchain, are you building on the back of like an Ethereum blockchain? Have you created something entirely different? What does that look like for those of my listeners who do nerd out more on the blockchain side of things?
So we partner with Algorand. So and what we do is we use Algorand's they have a protocol which is called the Algorand Standard Asset. And that's really an evolution that has taken place over the last few years. So when we looked at this originally 4 years ago, I think all of the blockchains were very much in their infancy and didn't really have the type of product that we needed to be compliant with securities laws. And those laws include things like being able to cancel someone's token and give them a new one if they've lost their wallet address. Because, with most other blockchains, if you lose your wallet address, you're done for. That's it. But you need, from a securities law perspective, if you can't find your certificates, you phone the company up and say, look, I've lost my certificate. Can you send me a new one? They say, yeah, of course. So you have to have things like that. So the blockchains needed to evolve to be able to be compliant with the regulatory requirements. And Algorand's ASA sort of structural protocol has been designed from the ground up to be compliant with securities. And what that means is you don't have to build a smart contract and take a protocol like Ethereum and wrap it with a smart contract and hope that no one breaks it for you, because it's actually part of the fabric of the blockchain. And what we use Algorand for is to evidence ownership of fractions of those home equity agreements. So when you buy a fractional home equity agreement from us, we deliver the ownership of that by way of a token. And because it's tokenized and we use the blockchain, when we say there's only ever going to be 100 shares or 1,000 shares in this home equity agreement, that that's going to be the case, because the blockchain means that we can only ever issue 100 tokens or 100 shares if that's what we say we're going to do. And that's publicly available information. So if you look at the token and you say, okay, how many tokens are in supply? And it says 100, then you know that you've actually got 100th or or 2/100ths, which is what you bought. So it's a great way of proving to anyone that wants to buy and trade these shares that the event that just happened on our platform where we said we've sold you that share, someone else is actually saying exactly the same thing, and they're a completely independent entity. In other words, it's recorded on the blockchain. And because it's blockchain, you don't have that double spend issue. We can't overinflate the number of shares. And that gives it that layer of trust, which is something that we build on top of what our platform already does. So it's there as well as all of the checks and balances that are built into our platform.
Thank you for getting into that, Matthew. And it leads me to a question that relates to the excitement around home equity contracts, because certainly, for me, I'm conversing with dozens and dozens of real estate agents and investors on a daily basis, and this is certainly something that more and more people are aware and excited about. What would you say has been the biggest challenge for you in delivering the concept to specifically investors and getting them in on this type of investment? Is there a significant challenge that consistently arises, or what's the general sentiment among more experienced investors with this home equity contract?
Well, I think it's all really, there are a number of challenges. The first and the major challenge is getting the investor really to understand what it is. Because if you say apples, they hear bananas. So in other words, if you say that this investment is an equity-based investment that delivers you a structurally leveraged return with downside protection, and it's based purely on the appreciation of the property, then the next question is, well, what's the cash pay? And well, no, it's not a loan. We're not lending the investors, the homeowners money. What we're doing is we are investing with them. And in 10 years or however long the agreement is, at that point, they owe us that fixed percentage of the value of the property. And then the investor says, well, how do I make money in the meantime? I say, well, it's a different type of investment. And that's why we created the platform, because the question that we get all the time was, well, if there's no cash pay and I've got to wait 10 years potentially for this to pay off, how do I don't want to hang around that long. So our platform creates liquidity. So if you buy these fractions and then the property value goes up and you think, oh, I'm sitting on a nice profit here, potentially you could sell those assets to someone else in our marketplace. But the biggest challenge that we have, just sort of coming back to your question, is really just education. And that works for homeowners too. Trying to explain to homeowners that this is not a loan. We're not lending you money. It's really just entirely based on the appreciation. So if your property goes down in value, you're going to owe us less because it's not a fixed amount. But when people get it, then they really get it. They say, why would I not do this? This is fantastic because now I can, get my equity. I'm happy to give away a percentage of the future value. And so I think really it's education. But once we have the opportunity of explaining it, and once the investor gets it, then you can see, the questions change and they become more like, well, hang on a second. So if the property goes down in value, I still make money. I can buy as much of this as you can make. I get exposure to owner-occupied real estate. In other words, I can invest in properties that are not for sale. So I can buy really, really good stuff because if the owner doesn't want to let go of it, I can still partner with him. So there's all the questions sort of change. So and the other thing is final piece of the answer is as more and more people come into this space, and we're seeing much, much more activity and interest now, then it becomes self-sustaining. Then you get enough of a groundswell, enough of a foundation of understanding that people go, yeah, I've heard about that. I read about that somewhere, or someone was talking about that. And that's, I think, the point where we're at now, where there's enough foundation there that people are much more open to these types of structures, both from a homeowner's perspective and from an investor's perspective.
But then that's where I was going next, was on the homeowners piece from a business development for QuantmRE. Like what is the prospecting and marketing approach look like to attract the homeowner, to convince them to, hey, put up your asset? Is it purely the education around, hey, we can bring liquidity to an illiquid asset without taking out a loan, taking out debt? Is it just communicating that out like in a marketing campaign, or how are you attracting the homeowners to fractionalize their property like this?
Well, the homeowner has a need, and that's what drives this business. Okay. It's not that they're interested in the concept of fractionalizing equity. It's the fact that they have a basic need to raise capital because of their personal circumstances. And in many cases, it's to clear existing credit card debt, or they may have some life-changing situation, health problems, or they've lost their job, or just the fact that they want to do something with their home but cannot borrow the money. So there are any number of different reasons why homeowners have a need across the US to raise capital. And this is a way to give them some of their own money. And this is the most important difference. And when we speak to them, we say, what you're doing is you're selling us something that you already own. And okay, we're going to agree a price, and we're going to agree a price that works for us. But it's going to work for you as well, probably, because, and if it doesn't work for you, you can just say no. That's the other thing. But it's an offer that is a reasonable offer because of all the risk that's involved. And that offer potentially unlocks, $500,000, depending on how much equity you have. And so for most people, for the homeowners, we're reaching out, and the message is unlock or access some of your home equity without going deeper into debt. If you're house rich and cash poor, we can help you access some of that home equity with no monthly payments, no interest, and no added debt. If you're interested, click on this button, take a look at our calculator, find out what your property is worth, how much equity you could unlock, and give us a call. And so that's it. It's really just a product that meets a need. And I think that need is going to continue growing as the economy goes through its ups and downs, and house prices continue to appreciate or maintain their value.
I would agree with that. I do want to ask the question, because you did bring it up, and I know a lot of listeners are probably thinking about it. You talked about how the investor still has a positive upside, even in a downturn. What happens at the end of the agreed upon period? Let's call it 10 years, and yes, I don't want to sell. Is it at that point that, as a homeowner, I then have to go out and find, a debt product to cover and get you paid back? Is that how it works?
Yes. So you've got a number of options. So if there's enough equity in the property, and in most cases there probably will be, because over a 10-year period, we know that in any 10-year period in our sort of last 150 years history, house prices have appreciated faster than the inflation. So you take any 10-year snapshot. So in 10 years, we are pretty confident that your property has probably gone up enough, and you've probably paid down your mortgage enough to be able to create enough equity for you to be able to renew the agreement if you want for another 10 years. So your first option, if there's enough equity there, is to take out another agreement to extend your existing agreement, or effectively, to give yourself another 10 years. And the other option is, you can, exactly at that stage, you can borrow money to buy us out. And most people, what they do is they buy us out much sooner than that 10-year period, because by giving them that capital that is theirs without it being debt, it puts them in a much stronger financial position. So if they had a bad credit score or low credit score because their credit cards were, maxed out, by taking this investment capital, which is not recorded as debt on your credit report, and using that to pay down all your balances, lo and behold, your credit score is going to increase. And you've also got a cash sum in the bank. So you've no longer got that sort of pressure of, meeting your monthly payments. So you're in a much stronger financial position as a homeowner. And that's why this is so different to lending people money, because you're making them go deeper into debt. This is how you pull people out of debt, by enabling them to access the value of their equity. And so you're putting the homeowner in a stronger position, which means they're much more likely to be able to refinance you out after a couple of years with a HELOC, or maybe another type of traditional mortgage product. And we don't charge any extra for that. In fact, we give them a bit of a discount if they settle the agreement early. So there's a maximum cap, so it's the opposite of penalizing them.
Wow. So my last question before I transition us into the last segment of the show. I mean, I could geek out on this stuff far too long for our listeners, but I know they're getting a lot of value. And the majority of my listeners are real estate agents working with the very home buyers and sellers that may find themselves in a house rich, cash poor situation. And so my question for you is, if you were speaking to an audience of real estate agents about QuantmRE and about home equity contracts, and they were to ask, hey, how do I leverage this in my business to grow my business? What would your answer be to them?
It's a way of allowing you to maintain a relationship with your existing base. Because as a realtor, the biggest problem that most people face is, how do I maintain that relationship with someone after they've bought the home? Because there's not much I can do, really. I can say, well, I know I sold you, this home last month. Are you thinking of selling it yet? You know what I mean? So other than that, or I could introduce you to maybe an insurance company. But this is a way where you can go back to your clients and say, look, I've been tracking the amount of equity that your house is generating for you, because that's easy enough to do. We all know how to do that. And I know that you're a bit of a savvy investor. And did you know that there is a way that we can help you tap into some of that equity in your home and diversify out of that single home, and maybe use that money for a down payment on another property? So I know that you're the sort of guy that loves investment properties. And I know that at the moment you're sort of struggling a little bit because your lending is maxed out and you're sort of hitting all of your maximum DTI ratios. But if I could introduce you to a way of releasing some of the equity in this property here, you could use that as a down payment on another property there. Now, it so happens that I'm the realtor that's in charge of that property over there, so that helps. But also, it means that I can keep a conversation with you without. And it's new. You probably haven't heard of this. So I'm not trying to sell you a mortgage because you just locked in at a phenomenal rate. I know you're never going to want to change that. But this is a way of me talking to you about maybe another property that you have. Maybe you just bought this property, but I know that you've got another property just up the road that's owned free and clear. So why don't we use some of the equity there and then diversify? Because I know that there's some property over here that's going to rocket up in value. So it's that ability to bring these innovative funding structures added to the fact that I've got an investment property that could be of interest to you. Here's an interesting way of putting the down payment together without borrowing more money. So you're going to increase your asset base without increasing your debt necessarily. And most importantly, it's a way of you can speak to that person every few months and say, I'm not sure if you knew, but you've now got this much value in your property, and these are your options. And I think that's something that isn't being done before. And I think most people appreciate the fact if their trusted realtor comes to them with solutions that they haven't already thought about, that could be some real value add.
I think that's huge value add. And I love exactly where you took that conversation. I mean, I tell my agents and agents across the country all the time that one of your biggest jobs is just keeping your toolbox full of tools that can be attractive to any one of your customer segments. And
Yes.
this is one of those tools that is innovative. It is new. It is something that not many people have heard of. And so even if it's not the right product or investment for them at that moment, you have solidified the rapport that you have with your clients just by being that trusted advisor who has brought that opportunity to them. And so,
Exactly.
I mean, I want all my listeners to go out and definitely, learn more about this and to find out. And I'm going to give you an opportunity to tell them where to go in just a second, Matthew. But I want to transition us into the last segment of our show. My listeners know it well.
Sure,
It's 3, 2, 1, action. It's the same 3 questions I ask every guest. We dove into your business a little bit. And so question number 1 is, who has been most influential on your business and business growth, and why?
It's funny enough. It's not a even though I spent a few years working with Branson. Funny enough, my biggest sort of inspiration is just a buddy of mine who lives in the UK. We shall remain nameless, but he built a very, very large multi-billion-dollar bank. And is one of the coolest, smartest. He's about 8 years older than me, but there's just so much energy and so much ability there, and so much application. And there's been an enormous amount of success. But he's also a great guy to be around. So it's just that the ability to sort of look at problems and come up with solutions, but at the same time, just have that staying power. I mean, he like us, has been working on projects for years, and it's a war of attrition in some respect, where you just chip away day after day after day, and then before you know it, you're ahead of the pack, and there's yards between you and the nearest competitor, miles even.
War of attrition. That's
Yes.
That is totally the game of entrepreneurship, and it helps have people in our corner that we get to look to. Question number 2 is, what book has been most influential on your business, and why?
Well, I'm not a great reader. Funny enough, because I tend to sort of fall asleep the moment I try and start reading something.
I have that problem as well.
And I like to learn because I'll read a little bit of it and then put it down. But now there is a book, and it's called Getting Things Done. And I can never remember who it's by. But it is a book that I sort of refer to when I sort of stumble across it every now and then. And we'll have to sort of do it in the show notes.
Yeah, we'll get that in the show notes. No worries.
But it's about how you, because I always used to wake up at 3 o'clock on a Monday morning thinking, I've got to do this, I've got to do that, I've got to do this, I've got to do this, I mustn't forget to do that. And you're going through over and over again this list of stuff you've got to do. And I just wish I could remember the guy's name. And
we'll get it in the show notes, but Getting Things Done.
Can you Google it now, for God's sake? Otherwise, everyone's going to leave. But what Alan was saying was that your mind is supposed to be for creating stuff. And so don't sit there listing through all the things you've got to do. Just write them down somewhere in what he describes as a trusted place. It could be a book, it could be an app or something. And so get all of that crap out of your mind so you know where all your stuff is that you've got to do. So you don't panic thinking, what have I got to do? Because you've written it down somewhere. So you can start relaxing there and start thinking about creative stuff. In other words, what is in my case, what are we doing with what are we going to do? How are we going to build this? How does it look? And you find yourself doing things that are far more creative and valuable, and you're using your mind to do things that are useful, as opposed to sort of, using this incredible thing for nothing more than a glorified notebook. But it hasn't, sadly, affected my ability to recall the author's name.
Well, that's because you're too busy getting things done.
But I know where to find it. That's the whole point.
Exactly.
To find his name.
Exactly. So you have applied his concept.
The ultimate, yes, yeah.
Exactly, to the nth degree. Well, question number 3, the third and final question of our show today is, as I told you, as you know, this is the All-In podcast where we encourage our listeners to take massive action to get things done. And so it's almost like we planned this, Matthew. If there was one thing that you've learned as a business owner that you would say to everyone listening today, if they asked you the question, what one action should I take to move my business forward? What would be some wisdom or a word of advice that you'd give to them on that?
Well, there's a couple of things. The main thing is take action. Okay, so it is take action, do something. And there's all this, various people talk about things. Have you been your best today? And you say, I don't know, but at the end of the day, have I actually done something today? Have I done something? Have I moved? It doesn't matter how incrementally. Have I actually moved everything forward a bit? Because that's the key. And the second part of the answer is, in order to be able to do that, you've got to have that sense of determination, because it takes a long time to get things to work, because you may have this vision in your mind, but you're way ahead of everyone else because they've got to catch up and understand, what you're talking about. And it takes years to do that. So it's that taking action every day. It doesn't matter how small, how incremental. But at the end of the day, you've got to be able to look yourself in the mirror and know that you're not fooling yourself. Now, that's the other thing. You've got to say, look, okay, maybe I haven't done too much, but I know that I've done enough to be able to enjoy that beer or whatever. The other thing is just pure dogged determination. What do they say? Success is 95% perspiration, 5% inspiration. So that is the truth that I've learned, that you just have to stick at stuff. You have to keep, and if you believe it, then it will happen. If you really believe it, you're unstoppable, because whatever happens, you will make it happen. It's almost like you sort of change the fabric of space and time. Yeah. And so you make it happen. So that's that is a truth. I think.
I would agree with you, and I love that it comes from someone who has been working on and refining his business in this space for a long time. And 4.5, 5 years is a long time. I mean, to stay just determined with grit.
We were a bit ahead of everyone. That's the problem as well, because it's a good idea, but so timing is the trick as well. So
there you go. It does have to. A great idea has to meet a great time in history in order for it to work.
Yeah, that does help. Yeah.
And I love that space and time has brought us together in this conversation. I have learned a lot. It has gotten me really excited about this vehicle. And I know listeners are going to want to, interact with more, learn more, find out more about QuantmRE. So Matthew, where can my listeners go to find out more about you, more about home equity contracts, QuantmRE, all the things?
It's all on the website. So it's QuantmRE without the U, so without the second U. Obviously, it's QuantmRE, QuantmRE.com. And everything's there. So we have calculators. So if you're a homeowner, you can find out how much equity you could unlock. You can register as an investor. You can have a look at the properties. So we only launched the marketplace last week. So we've got more and more properties coming onto the marketplace. There's lots of videos and podcasts and news articles going back a number of years. So you can watch the sort of development of the blockchain and this idea and the adoption of home equity agreements. And I promise you in a few years' time, it'll be just another run-of-the-mill financial product. And we'll be sitting there going, we were there at the beginning.
That's so cool. Well, I so appreciate you spending time with us, bringing value to my audience. There's so many ways, listeners, that you guys can go put this concept, this opportunity into practice, both on the investment side as a homeowner yourself and as a real estate professional who can bring this as a valuable tool to your clientele who may have that fundamental need for capital for a myriad of reasons. And so Matthew has done such a great job of introducing you to this. Do not sit on the sidelines. Take action. Visit the website. It's linked up in the show notes. And as always, go play all in.
Hey guys, thanks for listening to this episode of the All In Podcast. We want to invite you to find all of today's resources from our show page at aipodcast.co. We also ask that you take just 1 minute to leave us a review on iTunes or wherever you get your podcast. This is how we grow and how we're able to bring you the best content each and every week. Now go play all in.